Hello students. Today we shall discuss the subject Managerial Economics 22 MBA 26. In this subject we will be discussing about various concepts of managerial economics, that is in the first unit about introduction, the second unit about demand analysis, third unit about cost and production analysis, fourth unit about market structure, fifth unit is about industrial business policy, and sixth unit is about industrial fiscal policy. Now coming to the first unit, introduction. In this unit we will be discussing about meaning, nature, scope and significance, uses of managerial economics, role and responsibilities of managerial economist, relationship of managerial economics with statistics, accounting operations research, theory of firm, difference between firm and industry, objectives of the firm, alternate objectives of the firm, then managerial theories. Here we will be discussing about the different theories. They are Baumal's model, Mary's model and Williams model. Now let us know about what is economics. So this is a very common word, regular word. We will be listening to this, or we will be using in our regular life, in our daily life. So one standard definition for economics is it is the study of three important aspects, that is one is production, distribution and consumption of goods and services, because this economics is related to the business, that is to various industries, their production activities and the consumption of the manufactured goods and the services, various services. So how they are contributing towards our income, our individuals income, or to the national income. So such aspects we will be discussing here. So it mainly focuses on the production, distribution and consumption of goods and services. A second definition is the study of choice related to the allocation of scarce resources. That is again very important is the allocation of scarce resources, allocation of available scarce resources. In the first definition, it indicates that economics includes any business, non-profit organization or administrative units. And in the second definition, it establishes that economics is at the core of what managers of these organizations do. So that is, in order to produce, distribute and consume, so what is required is allocation of the scarce resources at the required period of time. So that is very important. So this economics is the study of allocation of scarce resources. Now coming to the meaning of it. Managerial economics is the analysis of major management decisions using the tools of economics. That is, managerial economics applies many familiar concepts from economics. They are demand and cost, and about the market structures like monopoly and the different types of competitions, the allocation of different resources and economic trade-offs. So that is at both the national level and international level, which aid managers in making better decisions, and it is a social science that studies how people use scarce resources to make best choice of the available resources. So the same has been symbolically represented here. So here we can see the limited scarce resources has to be utilized for production activity. Why the production has to be done? So in order to meet the unlimited wants and needs of the customers. So in order to meet unlimited wants and the needs of the customers, we are using the limited scarce resources. So this is the study of such thing is called as economics. So here the scarce resources are like land, labor, capital and enterprise, like this enterprise, entrepreneur, so they become the scarce resources. Again in the economics also can be said as where it tries to match the scarce resources with that of the unlimited needs and wants of the customer. So balancing that, no, so that study how the best allocation is possible, what are the best alternative choices available. So such optimum study of this, no, matching the limited scarce resources with that of unlimited needs and wants, no, that we call as economics. So here we have a definition given by Lionel Robbins. He says that economics is a science which studies human behavior as a relationship between ends and scarce means which have alternative uses. And here we have different definitions given by different authors like Haynes, Motte and Paul, then McNair and Merriam, then by Spencer and Siegelman, then by Mansfield. Here, coming to the first definition, it says that managerial economics is economics applied in decision making. It is a special branch of economics bridging the gap between abstract theory and managerial practice. And again, one more definition by McNair and Merriam, that is, business economics consists of the use of economic modes of thought to analyze business situations. And also, it is the integration of economic theory with business practice for the purpose of facilitating decision making and forward planning by management. And or it could also be concerned with application of economic concepts and economic analysis to the problems of formulating rational managerial decisions. So that is about meaning and definition of economics and managerial economics. The study of such application of managerial concepts in a business or economic concepts in a business by a manager is called as managerial economics. So in day-to-day business activity, a manager has to think of the different economical tools and activities and the best combinations of utilization of natural scarce resources so that they get the good results. So that study we call as economics. Now coming to the next important concept, that is nature and scope of economics. The nature of economics is it is microeconomics and it is normative. It is also a science as well as art, and it is realistic in nature. It includes macroeconomic analysis and it is interdisciplinary in nature. And its scope is it covers all the central issues faced by society, including economic decline and growth, poverty, unemployment, budgeting, etc. Economics is regarded as a social science. It studies how people in an economy employ the already scarce resources with or without using money. So that is about scope and significance. Now coming to the importance of managerial economics. So here we have different points, so which highlights about the importance of managerial economics. That is, the first point is it's a business planning and forecasting, analyze cost and production level. It we use that to formulate pricing policies, and also we use its applications in managing profit, and also will be used in capital management and in estimation of product demand, and in analyzing the market structure, and in profit estimation and planning, and profit and control of capital expenditure. So all these points will highlight about the day-to-day business activities where like before the production activity they have to fix the pricing policies, then analyze the cost and production level, then planning and forecasting for the procurement of raw materials and for the supply chain activities, then estimation of product demand, then meeting the demand with the supply of the goods or services, like that. So it covers all such aspects in the day-to-day life. So here this economics has been divided into two important concepts, that is microeconomics and macroeconomics. The two different conceptual approaches to the study of economics are, one is microeconomics and macroeconomics. Microeconomics studies the phenomena related to goods and services from the perspective of individual decision making entities, that is households and business. So that is, if we apply such economical tools and concepts in a firm, in by an individual in a single activity, that is in a single entity, that we call as microeconomics. Suppose if we apply the same phenomena at an aggregate level, that is at the national level for the society, for the whole people, no, that we call as macroeconomics. For example, the total consumption and production of a region, production of different commodities in a country. So such things we call as macroeconomics. So here we have a table which differentiates micro and macroeconomics with the different parameters. So this is again an important question. So this we have to know. So based on different factors, they have been distributed, they have been classified. Now coming to the next important concept, that is role of managerial economics. So once we understand what is economics and what is its nature, significance, then scope, importance, then the subtypes, approaches in economics. No? Now it is the role of managerial economics. Here we will be discussing about how to apply the managerial concepts and tools or techniques. So here the role of managerial economics is it is about study of business environment, and in production scheduling we need the concepts of managerial economics to control cost and to set price and bring coordination among the resources. Then in investment analysis, so in all the stages or at every different step will be applying the concept of economics. So here we have role and responsibilities of managerial economics. So once we understand the role of economics, then we have to discuss about the role of managerial economist. That is, it studies business environment, analyzes operations of business, demand forecasting and estimation, production planning, economic intelligence, performing investment analysis, focuses on earning reasonable profit, maintaining better relations. Now let us understand next important aspect, that is what is firm and industry, or difference between firm and industry. A firm generally refers to a business unit, whereas an enterprise, that is an enterprise undertaking the production of a commodity, whereas the term industry refers to a group of firms engaged in production of homogeneous goods. So generally the objectives of any firm will be uh, why it is taking up some production activity is to make some profit, or to maximize its sales, or for increasing market shares, or to build a good business reputation, then financial stability and liquidity, and maintenance of good labor relations, job satisfaction, leisure and peace of mind. So for these different purposes uh, the firm will be functioning. So with reference to this, we have a theory that is called as theory of a firm, so which again focuses mainly on the important objectives of a firm. So related to this, we have different theories. That is, the first one is profit maximization theory. According to this theory, objective of business is generation of largest amount of profit. That is the most widely accepted and most conventional thought is one who takes high risk in business can reap maximum profit. Traditionally, the efficiency of firm is measured in terms of its profit generating capacity. That is, profit is the only internal source of funds. Even the market shares are dependent on the profits earned. Profit is must for the long term survival of the business. That is, profit is equal to total revenue minus total cost. Then coming to Baumal's theory of sales revenue maximization. Here, according to Baumal, it is sales volume and not the profit that determines market leadership in competition. And he further stress that in large organizations, the management is separate from ownership. Hence, There would also always be a dichotomy of managers' goals and owners' goals. Manager's salary and other benefits are directly linked with sales volume rather than profit. So here again, comparing to the previous theory where it focuses mainly on the profit maximization, here Baumal says that where along with the profit, sales maximization is also important. However, empirical evidence to support above arguments of Bomal is not sufficient to draw any definite conclusion. So this is the main drawback in this model, and we have a next model called Mary's model of growth maximization. The Mary's model states that in order to maximize balanced growth rate or reach equilibrium position, there should be equality between the growth rate in demand for the products and growth rate in supply of capital. So when we look at all these theories, no, so these theories uh, concludes the same, that is, in a business activity, in order to generate a profit or to maximize the sales or to maximize the revenue, an integration of the resources and proper allocation of them, no, it is very important to that is the balanced activity of such will definitely yield in a balanced growth rate. So that is, we have to look at the growth of demand for products of a firm with the growth of supply of the capital, and also at the same time again utilization of the resources is also very important. So that was mainly highlighted in Williams model, where he says that managers have discretion in pursuing policies which maximize their utility rather than that of owner shareholder. Profit acts as constraint to this exercise, that is, the utility function includes one measurable viable, namely salary, and other non-measurable ones like security, power, status, prestige, professional excellence, like that. To formalize the model, one has to take proxy variables to these non-measurable ones. William model of managerial utility function, he says that so that is, as per the model of managerial utility function, managers apply their discretionary power to maximize their own utility function with the constraint of maintaining minimum profit to satisfy shareholders. That is, the utility function is very important. So like salary or their satisfaction level, or job security, power, status of status, so which are non-measurable measurable, but still they have influence on the profit and sales. The same has been written in the form of a function that we call as utility of managerial discretion, utility function. So this is about the introduction to managerial economics. Hope the concepts are clear and it is simple. So this lies the foundation for the next important concepts that we are going to discuss in the next video, like about the different factors of economics. They are demand, supply, then production activities, different factors, variables, and all the about cost related concepts we will be discussing. So to understand all these factors, no, the basics, that is the introduction to the economics, is very important.